This is something that I've been thinking about a lot over the last weekend and certainly over the last few weeks. There was a piece in the Wall Street Journal over the weekend talking about the recent IPO pops we've been seeing. Should investors be worried? Are we in a bubble? Not an overall tech bubble, but certainly a bubble for certain types of tech startups that go public. I think there's no doubt that we are, and note that according to this piece, valuations of recent IPOs relative to these companies' underlying revenue are at their highest levels since the dotcom era. Quote, investors this year have valued newly public tech companies at a median of 23.9 times the revenue they reported in the 12 months before going public, according to University of Florida business professor Jay Ritter, who tracks initial public offerings. That measure is by far the highest of the past 2 decades. For most of the 2010s, the median multiple for a tech company after its first day of trading hovered around 6 times its revenue in the prior 12 months. The same measurement for stocks in the NASDAQ Composite Index is 4.3, according to FactSet. So I'm going to interrupt again to say that the median of the recent IPOs is 23.9 times revenue. Back to the piece. Quote, I have a great deal of difficulty understanding the valuations of some of these companies, Mr. Ritter said. The difference in enthusiasm for the unprofitable young companies and old corporate giants with consistent profits is night and day, he said. The valuations imply investors are counting on years of continued rapid growth by these companies, hoping some will dominate their industries and churn out large profits, Mr. Ritter said. Tech enthusiasts and some observers say there are concrete reasons for the enthusiasm, as businesses across the country spend more on software and cloud computing services while more consumers are comfortable with ordering food or rooms on apps. Quote, without a doubt, there's a major transformation, said Jeffrey Sonnenfeld, a professor at Yale University School of Management, end quote. Well, yes, 2 things can be true at the same time. An IPO can be grossly overvalued, and also, sometime down the road, that same IPO might be worth even more money than it is today. Remember, Amazon stock was maybe a bit frothy in the late 90s and, say, early 1999, but if you timed it right, you'd still make a killing so long as you sold in early 2000. If you timed it wrong and sold around 2003 when Amazon was down to a $5 stock, then you maybe felt like you got it wrong. If you held that same clutch of Amazon stock for 21 years and sold it today, you're selling at $3,179 a share. So it all depends on your time horizon. If you have a Robinhood day trader's time horizon, then maybe reconsider getting into Airbnb at these levels this week. But if you have a Warren Buffett-style 40-year time horizon, then who knows? But the IPO frothiness has other tangible repercussions right now today. Both Roblox and Affirm delayed their initial public offerings, which were supposed to come this week, until next year. Why? Neither company thinks they can accurately price the shares of their offerings right now. That's how frothy markets are. Remember, every time you see an IPO pop 100% or so on its first day of trading, keep in mind that company could have raised as much as twice as much money while giving up the exact same amount of equity had the offering been priced closer to what the market bore out. In other words, companies don't want to leave that much money on the table. So at least these 2 companies are going to wait a bit for the frothiness to die down slightly.